What I'm going to do today is, first of all, I want to thank Danny and the gang from Mr. Top Step for having me in. I'm going to do something a little bit different. I'm going to do a little bit more of a formal presentation for you that I prepared that speaks to the proper money management and risk reward and position sizing. And I've got a canned presentation that I've done for my own traders, and I'm going to share that with you today. So let me just bring up the slides here. So my name is Doug McKay. I'm AKA Quantum Leap Futures. I'm probably closer to most of you retail traders in regards to the fact that I actually have a background in consumer electronics. I work for a family business. We have consumer electronics stores in Canada, and I got myself into trading at an early age, but I was really cutting my teeth on the junior miners and the venture exchange in Vancouver. And probably like most, I got a couple successful trades under my belt and hit it big with a couple trades on some juniors. And then, of course, thinking that I knew everything, I parlayed that into a large bet, disregarding protecting my capital, and I actually took a pretty big face peel and basically lost everything. I have been a proprietary futures and options trader since 2008. I made the turn beginning of 2009. Like you, most of you, I probably did the same thing you did. I started researching online, attending webinars, reading books, and looking for that holy grail and looking for that one indicator, that one methodology. I have a background in Elliott wave and Fibonacci and moving averages and market profile, and really what settled for me was volume profile and auction logic. I was a former director of trading for a company on Bay Street. The picture there that you see is actually the trade room that I built, and I run a small private trade room, online trade room for a group of customers. Please read through the disclaimer quickly. Just remember that trading futures or any instrument involves the risk of loss. Consider carefully whether futures or options are appropriate to a financial situation. Only risk capital should be used when trading futures or options. Investors could lose more than their initial investment. The ideas in this webinar are not my own. They are a combination of knowledge that I've gained over the years of my learning and trading. What I'm going to try to prove to you today is that the makeup of any successful trader or any successful trade plan is focused on not the methodology itself, but three key components, one being the most important, which is money management. The real job of any trader is capital preservation, because without capital, we are out of business. And then psychology and protecting our emotional capital is the second largest component of a successful trade plan. And then your routine, your research, and your preparation. But the methodology itself is not the most important part of the trade plan. So this webinar is designed to reinforce the most important part of any trade plan, and that's money management. So to do that, what I want to do is take a look at the relation of poker and gambling to money management. There's a reason why you see the same professional poker players showing up at the final tables of all these large events. Even though there's a randomness and an element of luck to the game itself, just like in trading, there's an element of luck and the market paying you. There is three main components that these professional poker players and gamblers have in common. One, they have studied and understand the odds or the statistical probabilities of their craft. They have used very strict money management to preserve their capital. They lose their stack, they're done playing poker or done gambling. And they understand that proper position sizing is based on the probabilities. They know when to bet small and when to bet big, okay, based on the statistical probabilities, but also the amount of capital or the amount of the stake that they have available to continue to play with. The game itself of poker may be random, but not the approach to the game itself. So let's look at a scenario, and let's pretend that you sit down at a blackjack table and you're empowered by a strategy that has a guaranteed winning percentage of 60%. Sounds great, sounds easy, sounds like you're going to make a lot of money. Now you're given $1,000 to play with, but you have to play exactly 100 hands. You can bet as much or as little per hand as you wish, but you have to play 100 hands or burn through the $1,000. With proper bet sizing and money management, a gambler would typically bet 10% of their capital after each hand. With a winning percentage of 60%, they should end up with an average of approximately 3,400 after 100 hands. I'm not promoting risking 10% of your risk capital. I'm just suggesting that if they did bet the 10%, that if they played the hands properly, they would average out at about $3,400 after 100 hands. The problem is, if this is true, why do 95% of the people lose in this situation? How is that possible? We have a winning percentage of 60% on our strategy. The problem is they fail to understand the need for proper money management and position sizing. So how can this happen? Well, let's take a look. Let's say you start betting 10% of the $1,000, which represents $100. And this is an okay betting size for blackjack in this scenario. The first bet is placed and it turns out to be a loser. So now the account is down to $900. So they decide to continue to bet $100 on the next hand. This now represents 11.1% of the account balance. So you're actually risking more a percentage of your capital on the second bet. And of course, as it can variably happen, the second bet is also a loss. So now the account is down to 800. So you've lost 2 hands in a row. So you continue with the third hand of betting $100 again. Okay, and we have a 60% winning percentage, so you're expecting this next bet to be a winner. And of course, okay, with the $800, this bet now represents 12.5% of your remaining capital. The third hand just happens to be another loser, and now the account is down to 700, and you had 3 losers in a row. So now you start to press the bet, and you decide to increase your bet by $50, so now you're risking $150, which represents 22% of the capital. The flop comes and you flop 2 10s, which gives you a 20. And the dealer flops, okay, he's going to have 21 to beat your 20, and he's showing a 6. This is great odds for winning, right? Coupled with the fact that the 60% winning percentage. So you say to yourself, well, I've had 3 losses in a row. I've got a high probability strategy. So what am I going to do? I'm going to double down on my 10s. And unlike most people think, Canadians do not split 10s. So they decide to press the bet and they double down, and now they're putting another $150 at risk. So now they're risking $300, which is 43% of their total stake of $700 left over. And just as can happen with all winning strategies, that losing side shows its ugly face, and the fourth hand is also a loser. The account balance is now down to $400 after only 4 hands, and you've got 96 hands left to play. They now have to have basically 100% or greater return just to get back to break even of the $1,000 by the end of 100 hands. They have basically completely blown their stake and have no realistic chance of making the money back or making any profit after 100 hands. Just as the gambler's bias enters gambling, so does the bias when you size your trade positions and how you manage your trading capital. Most totally ignore the random walk theory and ignore the third force probability. There's only three forces in the market. You have people that have taken a position short, you have people that have taken a position long, and you have that third force, okay, that's sitting on the sidelines waiting to step in. And at any given time, that third force can step in and squish you like a bug and prove your hypothesis wrong. They search for the certainty, the perfect setup, the perfect indicator, the perfect methodologies, if there was actually such a thing. Methodologies and indicators and tools are a fantastic toolbox for a trader. But without proper money management and proper risk reward, you're making it very difficult to be successful in the marketplace. The secret and the most important element in trading comes down to cutting your losses short, knowing where you're wrong quickly, and making sure that your profits are greater than your losses. Just to give you an idea, if you look at this chart, and this basically is a graph of what your drawdown is against your account and what the gain percentage is needed just to get back to break even. You can see when you keep your drawdowns small, it's not very difficult, okay, to get back to recovering your account. But when your drawdowns get 25% and greater, it's almost impossible. I mean, you get to a 50% drawdown, now you're 100% that you have to make just to get back to break even. And that's being a super trader, and there's not too many traders. Is it possible? Sure. But you'd have to be a very, very, very good trader. And most people that when they're starting in this business don't realize this, and they don't get the number of trades in that's necessary to make the turn. Malcolm Gladwell wrote a book called The Tipping Point, and his thesis was that in order to become successful and to become an expert in any given field or endeavor, that you needed 10,000 hours to do it. With trading, I really believe that it's more about the number of trades that you need to get in order to develop your edge. And if you focus on your risk reward, that is going to give you the ability to make the number of trades, to define your edge and become profitable and get to a positive expectancy. So let's take a look at risk models. In gambling, there's basically what they call a Martingale strategy. And basically this was developed in the 18th century. And basically it was you flip a coin, and if it's heads, you go, it's a win. If it's a tails, it's a loss. And the strategy has the gambler doubling down his bet after every loss, so that the first win that they get would recover all the previous losses and make a profit equal to the original stake. This Martingale strategy has also been applied to roulette in terms of whether it's going to land on red or black, and that's basically a coin flip of 50%. Since the gambler with infinite wealth will almost surely eventually flip heads, the Martingale strategy, okay, was seen as a sure thing for those that advocate it. Of course, what's the reality is most gamblers or most traders do not have infinite wealth, okay, and that the exponential growth of the bets would eventually bankrupt any unlucky gambler or any unlucky trader that tries to use the Martingale system. It's basically a good example of a Taleb distribution where the gambler usually wins a small net reward, thus appearing to have a sound strategy. However, the gambler's expected value does indeed remain zero, because this game is a zero net gain, and you have to develop your edge and control your risk management and the likelihood of a catastrophe is so great, okay, that the bet sizes as they rise exponentially, combined with the fact that the strings of consecutive losses actually occur more often than common intuition suggests. What do I mean by that? I mean that even if you have a winning strategy that's been proven out, let's say it's an 80% win strategy, that 20%, okay, can come at you all at once. And it can come at you. And most people, what happens is they have a strategy that, they've proved out and they think is a winning strategy, and then all of a sudden they get 2, 3, 4, 5, 6 losses in a row, and all of a sudden they say, this strategy doesn't work, this indicator doesn't work, I need to go and find a new strategy or a new methodology, okay, and find one that's worked, because this one doesn't work anymore. What they don't realize is that still could be a winning strategy. Even if your method has an 80% win percentage, okay, that very next trade you take, you don't know if that's going to fall in a the 20% loss category or the 80% win category. Now, casinos have eliminated the Martingale system basically by putting in table limits. So people with the deep pockets can't use it. Professional gamblers have long claimed that there's only two basic position sizing strategies. There's the Martingale strategy and the anti-Martingale strategy. Martingale strategies increase size when the equity decreases, while the anti-Martingale strategy increases the bet size during winning streaks or pressing it when the equity increases. Consider the following scenario and ask yourself what you would choose. If I offered you one of the two options, a guaranteed loss of $9,000 or a 5% chance of no loss at all and a 95% chance of a $10,000 loss, which one would you pick? The sure loss or the risky gamble? Well, most people, okay, would choose the risky gamble. But if you set it up as a mathematical equation, you can see that 10,000 times the 95% plus the 0% at a zero loss at 5% actually equals to 9,500, which is greater than the $9,000 guaranteed loss. Taking the risky gamble violates the first part of the #1 rule in trading. Keep your losses small. Now let's flip that around and consider another scenario. What if I offered you one of the two following options, a guaranteed gain of $9,000 or a 95% chance of a $10,000 gain and a 5% chance of no gain at all? Which option would you choose on this? The sure profit or the risky gamble? The majority would choose the sure profit. Why not? If somebody's going to guarantee you $9,000, why not? But in actuality, if you choose the risky gamble, you have a higher probability of having a larger profit. In the equation, 10,000 times 95% plus the 0 times 5% equals 9,500. So you'd actually make $500 more on the risky gamble. Taking the sure profit violates the second part of the #1 rule in trading. Let your winners run. 95% of the traders end up using something close to a Martingale strategy and lose their money. Successful traders, on the other hand, operate systems closer to anti-Martingale strategies. Position sizing systems that work call for you to increase the position size when you make money or when you are in the position of pressing. The purpose of position sizing is to determine the unit size based on your running account balance. It allows you to determine your risk reward by determining how many units you can risk on any given trade while maintaining a minimum, and I do say minimum, risk reward of 1-to-1. What I want to demonstrate to you here is you should be looking at something greater than 1-to-1 risk reward somewhere in the 1.5 to 1 or greater category. Position sizing is part of the 6 key elements to making money in trading. Those elements are system reliability, making sure that you have a proven setup or a proven methodology, proper reward to risk, the cost of trading, trade opportunity level. And what I mean by that is if you are risking 50 to make 100 and you're only trading once a week, you're really don't have a trading opportunity there. You're not going to grow your account size accordingly, and therefore when you're trading less, you have to be looking at larger rewards and more swing trading because you don't have the screen time or the trading opportunity level in order to scalp the market and operate within a smaller time frame. The size of equity, of course, what's your account size, and of course using proper position sizing. Once most traders have a profit, the problem, the psychology kicks in, and the fear of giving back forces them to take any sure profit at any sign of any adverse excursion against their position. I know we've all done it. I do it. You fall out. You go off the reservation all the time, and you make these trading mistakes by adjusting your stop or adjusting your profit. Even if the market has not proven the assumption wrong, you can't overcome this fear of letting profit get away. What compounds this problem is to have whatever current trade they are in become a winner. Because what they do is they start skewing. Okay, they manage a loser, hoping it'll turn around and eventually become a bigger loser, or they take a smaller loss that would have been a bigger winner. And more importantly, okay, they are adjusting their data set to test against that methodology or that trade setup. Because as soon as you get involved in a trade, after you determine what the trade is, then you're adding a variable, okay, which goes against your metrics of what the positive expectancy or the winning strategy is on that particular trade setup or methodology. Human nature is designed to create that bias, and it's the bias that gets in the way of most winning trade strategies. As a new trader, it's so important to protect your capital so that you can get in the number of trades necessary to define that strategy, build out your edge, and make the turn. What I mean by making the turn is getting to a profitable consistency overall, or a positive expectancy. And this chart demonstrates exactly, with using the example of the percentage of the account risk per trade based on $100,000 and the number of trades that you can get in based on that percentage of count when getting below $1,000 of equity. And you can see that 1% and 2%, you can get a fair number of trades in, hundreds of trades in, giving you the opportunity to define that edge and become a consistent profitable trader. But as you move the risk or the amount of capital that you put at risk, that exponentially the number of your trades drop dramatically. And I've seen so many traders blow up their account before they even get to 100 trades because they get the fear of their trading and they make all kinds of mistakes and they forget the first rule of trading is having proper risk reward and protecting their capital. So the 7 things that you need to determine before you enter a trade, and this is beyond the methodology or the trade setup, is these 7 things. 1, you have to determine where your current account balance is, not the starting balance, the current account balance, okay, and what your trade plan's max risk is and what your maximum drawdown is. Most people do not accept what their maximum drawdown is going to be, and any trade setup or any trading methodology is going to have a peak to valley drawdown. And you need to know what that is based on testing and based on tracking, so that you can accept what that maximum drawdown is. You need to know where your profit target is. Why? Before I get into any trade, I always look at where my target is. I need to know where I think the market is going, or what my hypothesis of where the market is going, so that I can put the stop where it needs to be for the market to prove that hypothesis or that assumption wrong. And then I need to determine where my entry price would be, and does it fit within my risk parameters. So what is the size of the stop that I need to put in to prove that hypothesis wrong? Is there a proper risk reward in the trade? Is my target greater than my stop, or at least equal to it, of a one-to-one risk reward scenario? And then based on that, looking at what my maximum risk is on the account balance, that's when I can determine what my unit sizing is. Once you have determined that your trade fits your risk parameters and is within your trade plan, you can take the trade. It's not that difficult. It seems like a big amount of steps, but you can do this on the fly. I usually do it in my pre-market routine, where I know where where the levels are that I want to trade and where I'm going to be wrong quickly. So let's just take a quick look at an example on how you would determine that. So this is just a particular trade setup. This chart's a little bit old because this is from an old presentation, but this is one of my favorite trade setups. It's a 3 candlestick trade pulling away from the 9 EMA. I won't get into the specifics of the trade, but this is my favorite trade setup. So the first thing I got to determine is what's my max risk. So let's say you've got $20,000 in the account, and you determine that you're going to risk 1.5% of that account. So you have a $300 risk for that particular trade. So I'm taking a look at my initial target. Now the target on this particular trade is the technical gap close against the 9. So my target would be 16.1725. The stop placement is below the low of the candle that creates the technical gap, and that would put my stop down at 16.0775. My entry price is going to be in around the 16.10 1/4. So my stop size is 2.5 points, so 16.10 less 16.0775, so I'm risking 2.5 points times $50 a point because I'm trading the ES. So that means that my stop risk is $125. Is my risk reward, is my reward, my target versus my entry greater than or equal to my stop, my risk for my stop? It is, yes. Okay, and then I can look, I've got a $125 stop risk. My max risk for any given trade is $300, so I can put 2 units on and I can risk $250. Not 3 units, because that would be beyond my, my max risk on that particular trade, or I can decide to go to 1 unit and move my stop further away, as long as the risk reward still equals out to at least 1-to-1 or better. So risk reward versus winning percentage. Most traders don't focus on proper risk reward ratio. What they focus on is they look at their winning percentage and what their P&L is, and that's how they gauge if they're doing right or wrong. Well, let me tell you something. You can make money in the market and still do things wrong. You can simply get lucky, but that is not going to last for very long. The problem with this is at no time do you actually know that your overall plan has a positive expectancy. What do I mean by that? Well, positive expectancy is the formula to tell you whether or not you have a winning strategy or a losing strategy. And the formula basically plays out as your winning percentage times the win amount plus the losing percentage times the losing amount. And this will either be a positive or a negative number. If it's a positive number, okay, and it covers the cost of doing business, then you have a winning strategy. If it's a negative number, you have a losing expectancy, and you're going to lose money overall, and you're slowly going to blow up your account. Even traders that believe that they have a proper risk rewards many times skew the results by veering from their risk reward by immediately banking a profit that gets 2 ticks in front of them, and they see something that they don't like, even though their assumption hasn't been proven wrong. They decide, I got to just take this down, so I'm going to close this out as a winner. Or worse, they move their stop, okay? Oh, it's not good. It's coming down to my stop, but I don't think it's going to go much further, so I'm going to widen my stop out. Or they don't want to lose as much as they originally put into their trade plan, so they move their stop closer, and then it comes out and takes them out, and then moves. Wouldn't have hit their initial stop, and then it rotates back, and it goes in their favor, and it goes and hits their target. And you blow your emotional capital, but more importantly, you're skewing your data set. Okay, so that you're altering your trade's statistical probability and performance metrics. When developing your trade plan, the most important thing is to make sure you are maintaining at least a 1-to-1 risk reward or better. Otherwise, you put the pressure on you to be right way more than you are wrong in order to offset the skewed risk reward. Let me just put that another way. The secret sauce of becoming a successful, profitable trader, okay, is skewing your risk reward properly. It's not the methodology. You can make money using many different methodologies and many different indicators, but if you don't risk less than what your reward is, eventually you're going to burn through your account. Or you're going to have to maintain a consistent profitability, a winning percentage that is so high to offset that risk reward. So what I'm going to do is I'm going to play out a few risk reward scenarios so that you can understand exactly how this is, and out as showing you and enforcing the fact that even if you only have a winning percentage of 50%, even less than 50%, if you skew your risk reward properly, you can have a winning strategy, and it takes all the pressure off of you. So for this exercise, what we're going to do is we have a coin flip simulator, and we're going to flip 500 times, so 500 trades, okay, using a singles future contract. And heads will be long and tails will be short. And we're going to set the account size to $10,000 with a commission set at $5. I know a lot of you are probably less than $5. We're just choosing an amount to give you a demonstration, so we went to the high side. And we're going to trade one contract to start with at a 1-to-1 minimum risk reward, so we're risking $50 to make 50. And then we're going to put it through the scenario using our risk reward simulator. The simulator will actually execute random coin flips with the desired win percentage and the risk reward parameters that you set. Now, due to the randomness of the outcomes, the actual winning percentage may vary from the parameter that we set for the winning scenario. So scenario 1, we're going to risk 1-to-1, so we're risking $50 to make $50, and you have a guaranteed 50% win rate. We're going to run 500 flips. So out of the 500 trades, 251 of them were winning, 249 were losing. That represents a 50.2% win and a 49.8% loss. After the 500 flips, your gross profit is actually $100. So you had 251 times 50, that's $12,550, and you had 249 losers at $50, and that's a loss of $12,450, giving you a net gross profit of $100. But of course, then you've got the cost of doing business of $2,500, so your net profit is actually $2,400, and your expectancy is 20 cents per trade. Your maximum drawdown was $400 and your maximum gain streak was $400, basically a 50% risking a 1-to-1. So let's see what happens. Clearly this strategy is going to lose money due to trade costs. So let's look what can happen when I simply take the same strategy and skew my risk reward. Okay, so I'm risking 50 to make 75. I still have a 50% win rate. So now we put the scenario through the coin flip, and you can see that it comes out with 248 winning trades and 252 losing trades. That represents a win percentage of less than 50%, 49.6, and the loss rate of 50.4. Your gross profit after the 500 flips is now $6,000. Your commission is $2,500, and your net profit is now $3,500. You now have a positive expectancy of $12 per trade and a winning strategy, and you still don't control, okay, the direction or the entry. All you're doing is controlling the risk. Am I advocating trading with a coin flip? Let me make it perfectly clear. Absolutely not. But what I'm saying is that as you're learning and as you're moving along your progression, if you maintain one thing and one thing only, is make sure that you're risking less than what you're looking to be rewarded on, and it takes all the pressure off you to be right, and you can be less than 50%. Most of you can be right at least half the amount of times. By simply setting a larger reward than loss, even a slightly less than 50% win rate becomes a winning trade strategy. Let's take that one step further. Now I'm going to skew my reward even more, still maintaining the 50%, and you can see that after 500 flips, you get a 51%, 49% loss. Your gross profit now is $13,100 because you're risking $50 to make 100, and less commissions, your net profit goes to $10,600, and you have a positive expectancy, and your maximum drawdown becomes less than half or half of what your maximum gain streak. So you're getting a much more acceptable maximum drawdown. This is just proving that risk reward is more important than your win percentage and driving that point home. Let's take a look at a fourth scenario. Let's say that you have skewed your risk reward to, you're still maintaining a 2-to-1, so you're risking 50 to make 100, but you only win 40% of the time. Can you have a positive expectancy? Absolutely. In this one, we actually came out, remember the simulator we can set the parameter by 40%, but due to the random walk, it actually came out at 37% on this, and our loss is 63. So we're losing way more than we're winning. But because we're risking less than our half of our reward, or risking half of what the reward is, our gross profit is now $2,750, less commissions $2,500, and after 500 trades, you are at a net profit of $250 and a positive expectancy of $5.50 per trade. And your maximum drawdown, okay, was actually this is flipped over. It should be the other way around. I think I put this in wrong. But the point of the matter is that even by losing 63% of the time, because you have a proper risk reward, you can maintain a slightly winning edge. Do I suggest that you only have a 40% win rate? No. What I'm trying to suggest is that you're taking all the pressure off you. Let's just take a look at what happens when you start developing an edge. So as you get your trades, the number of trades, and you're defining your trade setups and your plan, and you're creating your edge, even by getting to a 60% win rate, look what it does to your winning percentage and your expectancy. This one came out 300, so 60%, and 240%. Your gross profit is $20,000, your commission is $25,000, and you have a net profit of $17,500, or $40 per trade. And your maximum gain streak, okay, drops down significantly, almost 1/3, because of the fact that you're developing your edge. You're getting to a point where you can be consistently profitable. We can see that even by having a 60% win percentage and developing our edge, okay, proper risk of 2 to 1 does significantly increase your overall expectancy. But what happens if I'm risking, okay, more than what I'm winning? So in this scenario, we went to, I'm going to risk $50, okay, to make $25. But I'm going to have a high winning percentage. I'm going to maintain a 72% win rate. After looking at this, it actually came out that the win percentage was 71.6 and the loss was 28.4. So that's a fairly decent win percentage. My gross profit, okay, is $18.50 less commissions. I'm actually in a negative expectancy of $3.70 per trade. You know, I've got a maximum drawdown that's greater than my maximum gain streak. We can see that even maintaining a 70%, which is a fairly high win rate, a skewed risk reward creates an overall losing strategy. So what are the conclusions? There are infinite number of combinations of risk reward that you can test against a win percentage. Okay, you have to define your plan, build your plan, and know what the metrics are of that plan. But clearly, if you focus on the risk reward more than the win percentage, you make it much easier on yourself, okay, and your trading. You don't have to be right as much as you think when your risk reward is skewed in your favor, and it gives you the ability to create your edge. When you adjust your risk reward during a trade, you are altering the data set that tests against your plan, and therefore you don't know if that trade plan or that trade setup is sustainable as a winning strategy. It's a lot harder than you think to maintain a high percentage of winning trades without sacrificing your risk reward over a long period of time. Most traders do not operate in the 90 percentile. Okay, most traders operate somewhere between. It's easier to get from 50 to 60 to 65, but when you start getting above 70 on a long-term, you know, large sample size, it gets a lot more difficult. But that's okay, because trading is, you know, is all about understand losing. When I train a trader, the first thing I tell them, okay, when we get going, is the first thing you need to do to becoming a winning trader is to learn to lose, because it's going to happen on a daily and weekly basis, and those losing trades, the negative side of your trade plan is going to come at you all at once, and it does all the time. So what do you think is easier, maintaining a high degree of winning percentage or maintaining a proper risk reward overall? You know, going back to where we started, okay, are you starting to believe in this distribution model that the most important part of your trade plan is your money management and your psychology and your research and preparation? The methodology is actually the smallest amount of your overall trading strategy. So that's going to complete the presentation. I got through it pretty quickly. I'm open to questions if anybody has any questions. Well, the overall conclusion, Dee, is the fact that, you know, as newer traders or as traders, as we build our trade plan and develop our strategies, it is a lot less difficult, and it makes it so much easier. It actually makes it very difficult to blow up an account. One of the things we do for our traders as we're training them is we put them through a coin flip exercise. We give them an account of $2,500 and we have them do the coin flip. And heads they're going to go long and tails they're going to go short, and they're going to risk a one-to-one risk reward. And we want them to actually go through the process of understanding how difficult it is and how many trades that it actually takes to blow up that $2,500 account. You know, most people don't realize that if you without controlling the the direction or the entry, just controlling what your risk and reward is, okay, how many trades that you can actually get in. And the point is, in doing that, you're not going to use a coin flip exercise. You're going to eventually develop a strategy that has a higher than 50% win percentage, okay, and get to the point where you've developed your edge. I will send the presentation slides out to Danny, and I don't know if they can post them in the room or put them on the website, but yes, I can do that. I'm also recording this as well. The last line. What do you think is easier, maintaining a high degree of a winning percentage or maintaining a proper risk reward? You can control your risk reward. The real trade, okay, is done prior to entering the market. You always hear the idiom that, plan your trade and then trade your plan. Once you actually click the mouse and you've determined what your risk reward is, your job is done. Put your mouse away, okay, and let the trade work. It's either going to prove your hypothesis is right or it's going to prove your hypothesis wrong. You can't control what the market is going to do, but it doesn't matter, because if I have a positive or a better risk reward, okay, and I'm not risking as much as my reward, it doesn't matter, because overall my trading strategy is going to be a winning strategy. Well, the problem with paper trading also is you're not dealing with the psychology of trading, okay? And most people don't, do proper. I'm not advocating that paper trading isn't a good thing to help develop a strategy. But first of all, you have to understand that if you're doing paper trading, that most limit orders are filled right away. So you have to actually widen your target by at least one tick so that you have proper data set. So it has to trade through that target. But then a lot of people do paper trading, and they're going to start with a $25,000 account, and they're paper trading, and they're trading 10 and 15 and 25 lots, which is not, okay. People don't realize that in futures, okay, you have a very low margin requirement, okay, but the notional value of what you are actually risking is huge. You should have at least the amount of capital that's equal to your notional value. So for example, at $50 a point in the ES, you're on one futures contract, your notional value right now is somewhere in the neighborhood of $106,000, $105,000. Okay, and you can lose more, okay, than what you have in your account. Well, what will make that easier, I think it's Tilly, is making the transition from paper to live, is to fully embrace this idea of proper money management, okay, and understanding that it's very difficult to blow up an account if you're doing proper skewing of your risk reward and paying attention to your capital preservation. That's what really makes the other part of your trading, your psychology part of your trading, okay, move forward, because you lose that fear of losing, because you understand and embrace the fact that you're going to have losing trades on a weekly basis. and you can have a streak of losers. I mean, I've gotten to the point sometimes where I've got a trade set up and I get 8, 9, 10 losers in a row. Does that mean I have a losing strategy? No, it just means that the drawdown of that strategy, okay, is playing out, and I either accept that maximum drawdown, I accept my plan. I mean, most traders don't even come into this business with a trade plan. They don't have a routine, they don't have objectives, they don't have a strategy, they don't know what their max risk is, they don't know what their drawdown is, they don't track their metrics, and they don't work on their maintaining a trading log which tracks your trades and those metrics, and your key metrics being your expectancy, your most favorable excursion, your most adverse excursion, your best scale out, and your maximum drawdown. Those are the ones that are the key. All they focus on is, oh, did I make money or did I lose money? Instead of realizing that tracking your trading and having a plan and knowing what that plan is. This is a business. This is not a hobby. If you think you can come into this and treat it like a hobby, it will chew you up and spit you out. Yeah, I can make this this recording. If you go to, I will put this recording. I'll send it to Danny if he wants to put it somewhere where you guys can grab it, or I can put it up on my YouTube channel. Anyway, if that's it in the questions, I want to thank you for your patience and your time. Again, I'm more of I started in this business as a online trader, and I'm probably closer to you guys. I didn't have the experience of coming from the pits or from a large trading firm. Thanks, everyone. Everybody have a great day. Trade well, trade safe, and we'll catch you on the flip side.